Hello viewers, welcome to another financial accounting class in Prof. Bittaye's online digital classroom. Today's lesson of discussion would be centered on three things. The first one would be users of financial statements and their information needs. The second one would be categories or types of users of financial statements. And the last part would be types of accounting and their main functions. Therefore, stay tuned to the end of this lesson to learn greatly. Now, let's begin with users of financial statements. Who are users of financial statements? Users of financial statements are individuals, groups, or organizations that rely on a business financial reports such as the income statement or trading and profit and loss account, the statement of financial position or balance sheet, and the cash flow statement to make decisions. Therefore, anytime you hear or see the words users of financial statements, always remember that they are either individuals or groups or organizations that rely on a business financial report such as the trading and profit and loss account or income statement, the balance sheet or statement of financial position, and the cash flow statement to make decisions. Let's move on to look at the following users of financial statements and their information needs. Starting with owners or proprietors or partners or shareholders. Therefore, owners, proprietors, partners, shareholders as users of financial statements require information on profits, dividends, and liquidity position to assess the return on their investment. They need information from the financial statements to help them decide whether to retain, sell, or increase their investment. Therefore, the financial statement help owners, proprietors, partners, and shareholders to determine the business growth trends, retain earnings, and risk exposure to help them evaluate the business long-term sustainability. Another user of financial statements is management. Therefore, management as a user of financial statements need detailed information on cash in hand, bank balances, profits and losses, and capital employed for effective decision making. They need information from the financial statements to assist in the day-to-day operations, budget preparation, and performance evaluation. Therefore, the financial statements help management for strategic planning, cost control, investment appraisal, and setting future business objectives. Another user of financial statements is trade creditors or payables or suppliers. Therefore, trade creditors, payables, suppliers as users of financial statements require information on profitability, liquidity, and working capital to assess whether the business can meet its obligations on time. They also need information from the financial statements to decide whether to grant credit facilities, extend payment periods, or supply goods on cash terms. Therefore, a consistent financial performance reassures them of a long-term trading relationship. Another user of financial statements is banks or bankers. Therefore, bankers as users of financial statements look for information on the solvency and creditworthiness of the business. They also need information from the financial statements to assess the ability of the business to repay loans, overdrafts, and interest. Therefore, the financial statements help banks in deciding loan terms, credit limits, and risk exposure when dealing with the business. Another user of financial statements is employees or workers. Therefore, employees, workers, as users of financial statements are interested in the business profitability and liquidity position to ensure whether the business can pay wages and salaries and provide job security. They also need information from the financial statement to determine the future growth, the stability, and the benefit schemes such as pensions, bonuses, or allowances. Therefore, motivated employees are more confident when they see stable financial health in the business. Another user of financial statements is government. Therefore, government as a user of financial statements require business information for statistical, regulatory, and record-keeping purposes. Government uses financial statements to monitor industry contributions to the economy, employment levels, and compliance with laws. Government, as a user of financial statements, also rely on this data to formulate policies and regulate sectors. Another user of financial statements is tax authorities or tax officers. Therefore, tax authorities or tax officers as users of financial statements need accurate profit figures to determine the amount of corporate tax, value-added tax, fee or income tax, and other levies payable by the business. They also ensure that businesses comply with tax laws and regulations. Another user of financial statements is stock market analysis or investors. Therefore, stock market analysis, investors as users of financial statements study the financial statements to assess the profitability, growth prospects, and survival of the business in the long term. The stock market analysis provides insights for potential investors, stockbrokers, and financial institutions. Their analysis focuses on earnings per share, market value of equity, and return on investment to guide investment decisions of investors. Another user of financial statements is trade debtors or customers or receivables. Therefore, trade debtors, customers, receivables as users of financial statements, they are usually interested in the financial strength of a business, especially if they rely on it for long-term supply of goods or services. A financially stable business guarantees quality, consistency, and continuity of products or services. Another user of financial statements is the general public and the community. Therefore, the general public and the community, as users of financial statements, are interested in how the business contributes to employment, community development, and social responsibility initiatives. Financial statements reveal whether the business is ethical, environmentally responsible, and sustainable in its operations. Let's now move on to the second part of this lesson, which is the main categories or types of users of financial statements. Therefore, financial statements have two main categories or types of users. One is internal users, and the second one is external users. Now, let's begin with internal users. Internal users are those within the organization who use financial information for decision-making and management purposes. In other words, they are people directly involved in the management and operations of the business. Internal users are the owners or proprietors or partners or shareholders, as well as management and employees or workers. Therefore, owners, proprietors, partners, shareholders, as well as management and employees or workers are all internal users. This is because they are people directly involved in the management and operations of the business. The second category or type of user or users of financial statement is external users. Who are external users? External users are those outside the organization who rely on financial information for investment, credit, regulatory, or other purposes. In other words, they are individuals, institutions, or groups outside the business who use financial information for decision making. They use financial statements to evaluate, regulate, or invest in the business. External users are trade creditors or payables or suppliers, banks or bankers, government, tax authorities or tax officers, stock market analysis or investors, trade debtors or customers or receivables, as well as the general public and the community. Therefore, trade creditors, payables, or suppliers, banks or bankers, government, tax authorities or tax officers, stock market analysis or investors, customers, receivables or trade debtors, the general public and the community are all external users. This is because they use the financial statements to evaluate, regulate, or invest in the business. Now let's move on to the last part of this lesson, which is the types of accounting and their main functions. There are three types of accounting. We have financial accounting, we have cost accounting, and we have management accounting. Now, let's begin with financial accounting. Starting with the definition, then the purpose, and the main functions. Financial accounting. Financial accounting involves the recording, summarizing, and reporting of transactions between a business and external parties, such as customers, suppliers, employees, and owners. Its primary purpose is to produce financial statements, example, the income statement or trading and profit and loss account, the statement of financial position or balance sheet, and cash flow statements that provide a clear picture of the financial performance and position of the business. The main functions of financial accounting are to track revenues, expenses, assets, and liabilities, to provide information for investment and lending decisions, to ensure compliance with legal and regulatory requirements, and to help in assessing profitability, liquidity, and financial stability of the business. Now let's move on to the next type of accounting, cost accounting. Let's start with the definition, then the purpose, and the main objectives, or the main functions, rather. Now, cost accounting. Cost accounting is the application of cost principles, methods, and techniques to determine the cost of production or services and analyze variances between actual and expected or budgeted or standard costs. It is primarily concerned with cost control, cost reduction, and efficiency improvement. The main functions of cost accounting are to calculate the cost of goods manufactured or services rendered, to compare actual costs with standard or budgeted costs, to identify savings or influences or inefficiencies rather, to assist management in pricing decisions and profitability analysis, and to provide information for inventory valuation and financial reporting. Now, let's move to the final type of accounting, which is management accounting. We will begin with the definition, then the purpose, and the main functions. Management accounting. Management accounting is a branch of accounting that focuses on providing information for internal management decision making. Its purpose is to help management in planning, controlling, and optimizing resources to achieve organizational goals. The main functions of management accounting are to prepare reports, to support strategic planning and policy formulation, to analyze financial and non-financial data for decision making, to monitor and control business operations to enhance efficiency and performance, to assist in budgeting, forecasting, and risk management, and to provide insights for resource allocation, investment or investment appraisal, and performance evaluation.